From New York City, for our viewers worldwide, I'm Dani Berger. Bloomberg Real Yield starts right now. Coming up, U.S. consumer sentiment plummets to the second lowest level on record. The soft data sending yields higher across the curve, with 30-year yields back near 5%. And on the credit side, easing trade tensions unlocking a rally as optimism surges on corporate debt. And we begin with the big issue, uncertainty persisting over markets.
There's a lot of uncertainty out there.
We're still uncertain about how this is all going to turn out.
We don't know what kind of lags have gone on in the system.
The risk to the downside in growth, I think, is real and present danger.
Tariffs are still net significantly higher.
The key now is restoring confidence.
And that soft data does eventually translate into harder data.
The data is not indicating that a recession is around the corner.
We don't foresee a recession in 2025.
Folks think that the economic backdrop is not going to be a recession.
The bond market is clearly going to be the arbiter.
The bond market is certainly on edge.
I think our yields are not going to get that great support.
You're not getting paid for the risk.
You're going to continue to see yields move up on the higher end.
The U.S. 10-year yields, if you get to 5%, is very, very attractive.
It's the deepest, most liquid, broadest market in the world.
The Fed will take it very easy here.
As long as the Fed can wait, they will.
The Fed is going to be criticized for waiting. They have to wait.
Well, here's something else that has thrown a spanner into the works. 2 hours ago, University of Michigan survey data hit. Look at what happened to one-year inflation expectations, surging to 7.3%. That is the highest level since 1981. A really, really remarkable move up and very different from what this market is saying. One-year inflation expectations and break-evens are something like 3%. It's not just that. If we take a look at the next chart, it is a stagflationary type of feel that you are getting. Sentiment, meanwhile, that plummets, falling to the second lowest level of record. 3/4 of respondents cited tariffs as their concern. And both political parties move this way. And I should say Democrats and Republicans, the spread between also shrunk. Now, I should be clear on the timeline for this. The survey was conducted between April 22nd and May 13th. So it only just starts to capture the beginning of the trade deal with China and the U.S. Notable nonetheless, markets seem to kind of be moving on it. And speaking of shaky data, JP Morgan CEO Jamie Dimon also joined Bloomberg TV earlier this week. He gave his forecast on the chances that the U.S. falls into recession.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
Let's add some more expert voices to the conversation. Joining us now, Tony Rodriguez, head of fixed income strategy at Nuveen, and Robert Tipp, chief investment strategist and head of global bonds at PGIM Fixed Income. Thank you both for joining. Tony, I got to start with you on this University of Michigan sentiment survey data. Another piece of soft data that looks really poor. How much faith can you put in it when it is a quickly moving trade conversation and data that doesn't necessarily capture it in real time?
Yeah, it's a good point. The information is moving very quickly. In addition to that, if you look at the expectations for inflation surveys out there, the New York Fed does one as well. That one we think is a little bit more legitimate. They kind of survey the same group of people, so you get more consistency. That has remained a little bit more well-contained. It's still high, but not nearly at the levels of the Michigan. So we generally tend to discount the Michigan inflation expectations number. But when you talk about the sentiment number, there we do think that is a consistent story across multiple surveys and consistent with our expectations that you are going to see a slowdown from the consumer, which will lead to a slowdown in the overall economy. Not to recession levels in our mind yet, but certainly making us more vulnerable to any kind of shock that might push us into recession.
Robert, let me bring you into the conversation. What do you take into account with this University of Michigan survey? Are you like Tony? Do you discount inflation but look at the sentiment readings?
I think, from Tony's perspective and my perspective, these are really good numbers. What we want is a Fed that's looking out for an unanchoring of inflation expectations. And we've been through an incredible period of high inflation that's not been seen for several decades. And we need to know that the Fed is going to be there to cap that inflation and that they're not going to get distracted. And I think that, at times we've been at risk of the Fed needing to attend to both sides of its mandate. So I think that aspect of this is good. It keeps the Fed alert that they need to keep inflation expectations anchored. And the next thing, though, is surveys. Surveys have dislodged from reality kind of post-pandemic, especially the last few years. So I'm not so worried that there is a reality that activity is going to crash. I'm not so worried that there's a reality that inflation is going to soar. But I think that the economy is going to moderate. And that's why I was saying this is good news for Tony and myself, because for fixed income, which is at a very attractive valuation point, say relative to equities, a little bit of moderation in economic growth and a Fed that's going to cap inflation is a really good environment for fixed income.
I see you nodding your head, Tony. I mean, are we going to look at 30-year bonds around 5% and say, man, that was a generational buy opportunity?
We do think that it's going to be an attractive buy opportunity. We think there'll be some modest pressure lower in yields when you think about over the next, call it 6 to 18 months. So we don't think that movement is going to start until we get closer to, let's say, end of the summer. We don't think the Fed will actually start to cut rates until September. They'll have to wait because of inflation coming through strongly here with the initial tariff implications. Eventually, the growth impulse, which will be softening growth, will allow them to start to cut rates. But we think that at the kind of long end yields, think about the 10-year, the long bond, kind of 4.25 would be where we think the 10-year ends the year. It's only modestly lower. So a 4.5 10-year seems fair to us for the moment. A 30 that might get to 5%, that would be an attractive kind of medium-term buy for investors, we think.
Is it difficult, Tony, though, to jump in and buy when over the weekend and today we're getting the discussions of taxes, we're getting discussions of deficit. We've kind of put trade to the side at a moment with what the fiscal deficit looks like and whether it's going to be prudence from Capitol Hill that seems to be lacking it at this moment. Does that make it a tougher sell?
It does. I mean, we don't expect fiscal discipline to suddenly appear out of Washington, D.C. at all. So we do think that that pressure from financing needs and continued kind of 6-7% deficits to GDP is going to keep longer rates higher. So we expect, if you look at the curve, it should steepen kind of 2s, 10s, 2s, 30s over the next 6 to 18 months because the front end will eventually follow the Fed cuts. The long end, only a modest reduction from here because of that pressure on the term premium that comes from a lot of these deficit discussions.
Robert, what say you? Front end fixed by the Fed, but what about the long end? Is there still going to be pressure coming from the budget discussions out of D.C.?
Right. I think there'll be pressures coming from the budget discussions in two fashions. The one, supply, is an ongoing factor that is keeping yields around the world higher than they would be otherwise. But, you're going to get potentially some stimulus coming out of this, too, and so better growth. So I think it's important to manage expectations and manage tactics with regards to this bond market here. I think since rates popped up into the 4s in 2022, it's been apparent that this is a pretty resilient economy. This is an economy that has been able to cope with a 4% and 5% plus Fed funds rate, has continued to grow, and that it may continue to face only, a Fed that only begrudgingly cuts rates. And so I don't think this is going to be a bull market where you're going to get a big collapse in yields and a huge increase in prices, which I think is the same as what Tony is saying. I think it's going to be one, though, where for people that are buying, diversified fixed income, high yield, and getting these 6%, 7%, 8%, depending upon their risk tolerance kinds of yields, are going to end up 5-10 years from now looking back, having had a really smooth ride compared to what may happen in other markets.
So, Robert, it's going to be stimulative coming out of D.C. I want to go back to that point because how do you distinguish the line between what is stimulative coming out of tax cuts, out of legislation, versus just irresponsible and too much spending and too many ballooning deficits?
Right. Well, too many ballooning deficits, I think, is the point. And, you have to put us in a global context in every regard. So, where are we relative to France or Europe in total in terms of an ability to grow and an ability, if need be, to raise taxes relative to GDP? We're way ahead of them. All countries in the world, for the most part, the major DMs, sequentially the last 25 years have all increased their debt to GDP ratios. So we're, everybody's 100% debt to GDP these days. Do you want to have a country that has autonomy, has geographic security, or a region of a handful of countries that needs to coordinate their defense and, has much more moderate growth and already a very high tax percentage. So I think that the U.S. in the abstract is okay. Do I like this? I don't. But our yields, as you pointed out, at the 30-year are at 5%. No one has, in terms of when you're looking at Europe, you're looking at bonds, you're looking at JGBs, a lot of this is already kind of in the market. So marginally, is it a negative? It is. And that's why I think, we have a higher interest rate environment now, among other reasons, compared to where we were at various points in the past. But I don't think it's going to be a paradigm shift to much higher yields from where we are now.
All right, gentlemen, we're going to have to leave it there. Thank you both so much for joining on this Friday. Tony Rodriguez of Nuveen and Robert Tipp of PGIM. Fixed income setting you up for what is likely to be a lively debate on Capitol Hill today and over the weekend. Up next, the auction block. Debt investors eating up bonds as McDonald's and others see strong demand for their debt sales. See what we did there? We talk credit next. This is Real Yield on Bloomberg. I'm Dani Berger, and you are watching Bloomberg Real Yield. It is time now for your auction block, where U.S. and European companies race to borrow debt, looking to seize on the risk-on mood in markets after the easing of U.S. and China trade tensions. Now we start in Europe, where we had the busiest week since January, with volume topping 92 billion euros. McDonald's and Pfizer joining a record spree of reverse Yankee bond issuance that now stands at over 82 billion euros. It was Pfizer's first euro bond in 7 years. Now back here in the U.S., high-grade sales volume came in above $40 billion for the second consecutive week. Sales were highlighted by UPS, U.S. Bancorp, and SocGen. For the month, the total sits at $95 billion. Meanwhile, in high yield, companies sold junk bonds totaling more than $11 billion for the week. It included sales from the likes of Avis, Carnival, and Kohl's. In particular, the Kohl's sale was its first since 2021, and the first time the company has ever tapped the junk market. It saw $1.75 billion of demand for its $360 million sale. Now, thanks to recent trade optimism, spreads have dropped and made the market appealing for companies looking to raise cash. It has also caused some big bank analysts this week to predict tighter spreads by the end of the year. Citigroup's Richard Zogeb says that credit held up amid the volatility.
A big defining moment for fixed income was right after Liberation Day, when the equity market was super volatile and the fixed income markets had real, normalized selling, no panic selling. Spreads widened a little bit, but it was incredibly functioning and snapped back quickly. So I think that's going to encourage more money. And so I don't see this liquidity position changing.
Pleased to say, joining us now, Amanda Lynam, head of macro credit research at BlackRock, and Winnie, Cisar, global head of credit strategy at Creditsights. Great to have you both alongside me on this Friday afternoon. Amanda, spreads are back below to where they were pre-Liberation Day. Did we move on too quickly?
That's right. Well, thank you so much for having me. We're in most markets, at least in U.S. credit, we're back to mid-March levels. I would say three things are standing out from our recent conversations, especially since the news over the weekend. One, there's an acknowledgement that there's a lot of uncertainty, but I would say optimism that the U.S. economy can power through this. Two, there's a significant focus on what I would characterize as kind of back to basics credit work, acknowledging we don't understand a lot of kind of the forward path, but let's focus on what we can control, underwriting structure, cash flows. And then third, there is a significant amount of focus on finding opportunities to navigate in this environment. You saw it in the oversubscription levels of new issues that you mentioned. You can see it in 3 weeks of inflows in the U.S. high yield market. There's really a front-footed, proactive approach. I think there's an acknowledgement that we just can't time when the hard data, for example, might catch down to the soft data, and folks don't want to be under-risked or under-invested, and I think that's going to carry through for at least the next few months.
Winnie, would you agree with that what we're seeing is folks just getting back out there in the market while we have this kind of pause and volatility?
Definitely agree with that. From talking to a wide range of clients, people came into this year with a good amount of cash in their portfolios because technicals were just so strong in 2024. And the net issuance side of things, while we've seen a pretty significant headline number in gross issuance, most of that supply has gone towards refinancing and GCP and not necessarily incremental new debt deals. And with that technical backdrop, I think that a lot of clients are looking at how short-lived the volatility was in April, despite the fact that the headlines were really very significant and quite severe, and worried about missing out on spreads at 100 basis points or 95 basis points, potentially going even tighter than that.
Is there not some risk, Amanda, though, that we are whistling past the graveyard? Sure, we have 90 days, but there's an argument that damage has already been done, and headline volatility risk is so high at this moment. When issuers have started to flood the market, can we be sure that demand is going to be able to continue to absorb that?
I think that's a great point. We are, at BlackRock, expecting a more challenging growth inflation mix over the long term. The key point there is that the magnitude and the timing of that is very uncertain. I would say, to your point, there's a reason that spreads, for example, are still wider than where we started the year. So we're back to mid-March levels. We're not back to the post-financial crisis new tights that we set in February. And so there is, I think, somewhat of a risk premium that's baked in. I do think that can move a bit wider. The one kind of saving grace, however, in the corporate credit market is that the all-in yield opportunity is still really attractive. And so I think that will be some anchor on credit spreads relative to, say, what otherwise might be the case. But again, going back to the point, it's really difficult to time this. And I think given the volatility and the kind of dynamic snapping back that Winnie mentioned, I think folks just want to stay invested in there's a bias to kind of ride through while keeping risk levels pretty constant as opposed to being under risk.
Yeah, I got to say that snapback in volatility, Winnie, that you pointed out, it was so remarkable. Just looking at the equity market statistics, I think it was the quickest recovery for the equity market since 1982. So credit markets seeing a very quick snapback too, reflecting that risk. How surprised were you that we moved on so quickly for it? Is there any signal to be gleaned in just the speed and pace at which we reversed a lot of the pain in the market?
I think that there are some things to be gleaned. First is you can't fight the momentum. We have had over 18 months of this point of very strong risk on momentum as cash balances are robust across a wide range of measures. Now, the big caveat to that is assuming that the cash is always going to be there or assuming that the fundamentals are always going to remain intact, I think is a little bit misplaced at this point, as we do know that some level of damage has probably been done given the period of uncertainty and incremental uncertainty, as we still don't know kind of what happens at the end of this 90-day pause, what happens with the fiscal plan. There are still a lot of big question marks that we have. So to assume that the 2024 type status quo, where risk is always well bid, volatility usually snaps back quite sharply, I think is a little bit of a misplaced assumption at this point.
To the fundamentals, Amanda, at the moment, the hard data looks benign. CPI, PPI this week all came in as a relief. It continues to be the soft survey data. University of Michigan sentiment survey this morning, that looks bad. I mean, let's put it simply. At what point, if at any point, does the hard data start to catch up? Do you assume that that does happen and ruin some of the risk on rally we've seen?
So two things I would say. One is I think this is more of a second half of the year event. If you listen to what the actual company commentary is, they're still working through inventory. They've front-loaded some of these policies with imports. And so there's a lag that will happen where that hard data will probably need some time to flow through. The second point is that corporate fundamentals have entered this from a position of strength. And actually, this is part of the reason why we're comfortable moving down in credit quality selectively, because actually in some pockets of the high yield market, for example, credit metrics have converged up into their investment grade peer groups. And so all things being equal, there's a bit of a cushion to navigate through this. But I absolutely agree. Just because we haven't seen the catch down in hard data yet doesn't necessarily mean it's not happening. I think there are just some really important buffers in timing, balance sheet strength that will mitigate that somewhat.
Yeah, Winnie, let me get your thoughts on this. Does the hard data catch down, and what does the timeline look like for it?
Yeah, so we do think that at some point the hard data will start to slow down a little bit or look a little bit less attractive in general. We have been expecting this kind of stagflation type light scenario with a downdraft in GDP growth and a little bit of an uptick in inflation. Historically, the soft data have not been particularly strong forward indicators, especially on the inflation side of things. But we are seeing some more hard data, especially around import prices, which hit this morning, that are showing some slight upward pressure on the inflation side of things. So we do think that at some point this year, probably in Q3, Q4, companies are going to be looking at the bottom line and trying to figure out how do we balance the decelerating ability to pass through pricing with the reality that some of our input costs are a little bit sticky. And what does that mean for our labor needs?
Well, we heard a big company start to discuss that this week, Amanda, and it was Walmart, saying that at some point that they're going to need to rise prices, that they can't keep absorbing it in the form of margins and margin weakness forever. Does that give other retailers the cover to do this? Is Walmart almost the canary in the coal mine for inflation pressures starting to hit consumers and prices going higher?
I would say there's a significant amount of dispersion across a wide range of sectors. So leaving that company aside, what you see is that you can't paint all of these asset classes or sectors with a broad brush. We're seeing a significant amount of dispersion in terms of their pricing power, fundamentals, ability to move forward. I think that's really the key to focus on. But to your point, if I had to pick one kind of feedback loop to monitor, it's this really important signal between company margins, the layoff rate, which is still low, consumer spending, and overall economic activity. If margins are pressured and companies flex that layoff tool more aggressively, then I think we need to reevaluate kind of the temporary reprieve in risk assets that we've seen.
Do you think consumers are willing and able to pay more after we just went through COVID and price fatigue really set in at that point?
I think, again, to the point on dispersion, there are some brands, there are some experiences that really matter. It helps a lot that the layoff rate is low. The counterbalance to that, however, is that the hiring rate is also low. So if consumers start to fear about the strength of their employment backdrop, if they're laid off, it may take them longer to find a new job. That's where you can kind of get that self-fulfilling prophecy. Not our base case. It's never been our base case for a recession, I should add. But that's really the feedback loop that we're watching.
By the way, in terms of who is able to raise prices, Virgin Galactic announced last night that they will be raising prices for their space flights. So that's one place of inflation that I guess people are willing to take. Winnie, I just wonder what your take is on this. Are we going to see a period of inflation or margin compression, or is it a mix of the both?
We think that it's a mix of the both. While space flights apparently are a discretionary thing that people still want to pay for, not me personally, we have seen pushback in pricing on other discretionary parts of the corporate world, especially on the airline side of things for, the back of the plane, the more economy type seating. And that has come at the time where we've seen much more supply come online, which is a really difficult operating environment for airlines overall. On the other hand, on the good side, that has been the big driver of disinflation and deflation for the past few years. And we've started to see that creep up a little bit. Now, the April data were a little bit better than expected, especially on things like used vehicles and apparel. But that is the combination of a work through some of prior inventories and perhaps some promotional activity ahead of tariff impact. And when we think about the 30% agreement with China currently from a tariff rate perspective, that almost seems kind of the worst possible outcome for inflation because it's big enough to matter, but not necessarily big enough to have consumers just say, oh no, I can't pay $4 for that thing that might have been $3 originally.
Winnie, I'm so glad you brought that up because that does seem to be an idea that's starting to percolate around markets. Just so we're clear, is the idea that if we had gotten massive tariffs, that would have been disinflationary because you get something that looks like a recession. But if it's no recession and a little bit more expensive, what does inflation look like?
Yeah, absolutely. In the prior regime where we had 145% tariff rate, that was effectively a global moratorium on trade with China, or at least the U.S. moratorium on trade with China, which was going to result in something really significant from a downside perspective on the economy. But if we have this tariff rate that is elevated, which it absolutely is, but not necessarily as eye-popping as that triple-digit tariff rate, then I think that there's going to be a little bit more of a kind of trial and error period for a lot of companies figuring out what exactly can we pass through. And that worries us a little bit.
Yeah. All right. We're going to have to leave it there. Amanda, Winnie, thank you both so much for joining. Amanda Lynam of BlackRock and Winnie Cisar of Creditsights. From New York City, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and you're watching Bloomberg.